I wouldn't say markets are necessarily reading it wrong, but I would say as uncomfortable as we are seeing yields at near one-year highs, I don't think that this is going to be the level we see a few months from now. And I think that's more important because ultimately, if yields begin to fall because inflation pressures are easing, or if the job market is a bit softer than expected, it really puts the Fed back in focus. So I guess what I would just say is it's not comfortable to be here at where yields are. I don't think it really breaks markets, but I don't think yields are necessarily moving higher over the next few months.
Tom Lee discusses market conditions, particularly the recent rise in bond yields. While uncomfortable, he believes this will not be the norm for the next few months. If inflation pressures ease or the job market softens, yields could fall, bringing the Fed put back into focus, which would provide support for the markets. Lee also comments on the performance of small-cap stocks, which have underperformed recently, particularly over the last decade. Despite the slow growth, Lee sees a potential rebound in 2025, with the possibility of better market conditions. He highlights the value of small-cap stocks, noting that their price-to-earnings ratios are significantly lower than large-cap stocks, which makes them attractive for future growth. On the topic of speculative technologies like quantum computing, Lee acknowledges their high volatility but encourages a long-term investment perspective. He believes the market often underestimates the potential of transformative technologies, citing AI as an example of how initial skepticism can give way to rapid adoption. For quantum computing, despite its uncertainties, Lee sees opportunities in the sector for those willing to hold through short-term volatility.
Well, it's particularly uncomfortable, arguably, for small caps. Early last year, probably around this time, you made a bold call on how much small caps could rise. You've moderated from that since. But where do you see small caps going now? Why didn't the big pop that you projected for 24 pan out?
Yeah, small caps have been disappointing. I mean, unfortunately, I think there's been a rug pull on those names a few times, so I think investors are going to be very wary. But to us, I think the roadmap for 2025 is still one where the opportunity for stocks to have much better breadth widens, because not only do we have an incoming administration that is pro-business, and I think it is going to boost CEO confidence. It's pretty evident now, even seeing it in both ISM readings recently. But that's going to be a better environment for mergers. So to me, while small caps have been big laggards, actually for the last 10 years, this 10-year underperformance to the S&P is the worst in actually almost 100 years. So second only to 1998. And then from a valuation perspective, small caps are still much more attractively valued. The median PE is around 11 times, and that's almost 7.7 turns cheaper than the S&P. So it's been tough, John, to be overweight small caps, but I think they're going to work in 2025.
Okay. I do want to get your thoughts on some of the riskier assets or the riskier parts of the market that, or I'll use the word maybe potentially more speculative. Case in point, the quantum computing stocks, they had a huge move higher. Jensen Huang from Nvidia comes out yesterday, makes comments saying that, some of the supercomputers are still, and the full, realization of supercomputers is still decades away, and you see all the stocks tumble. I know there's one that you like in your granny shots here. I believe it's IonQ. Just want to get your thoughts on what we've seen in some of these parts of the market and how to think about investing, if you should be investing in some of these more speculative or futuristic frontier tech-like companies.
I think investors do need to put a long-term lens on a lot of these important mega themes. I think quantum computing is in the earliest days. I don't think anyone can judge really whether it's 15 years away or 15 months. And I think people have made many mistakes over the past 20 years looking at things like social media and underestimating the adoption rates there, or internet, or even AI now. I mean, just think about 2 years ago, how many people were saying AI was going to actually take far longer than expected. That being said, I do think the environment for stocks hasn't been great for the last 3 weeks. I think it's really gotten people into a recency bias, thinking, look, we've neared a top, or that stocks are just awful now. I think we're getting close to the point where, you should be betting really and leaning heavily against that. I mean, even look at AI sentiment, it's almost back to negative. But Morgan, regarding quantum specifically, it is a pretty innovative technology. I think these are going to be high volatile names. And so until we get back to risk on, they are going to be tougher names to own, but I don't think that means you have to sit them out in 2025.
Nvidia criticizing new chip export restrictions put in place by the Biden administration, potentially saying that the White House is preempting incoming President Trump by, quote, enacting a policy that will only harm the U.S. economy, set America back, and play into the hands of U.S. adversaries. The additional round of restrictions originally reported by Bloomberg this week, saying that it would cap the sale of U.S. AI chips on a country and a company basis. We're looking at the stock under a bit of pressure here this morning, off just about 2%. Ned Finkel, he is Nvidia's vice president of government affairs, saying in a statement that the extreme country cap policy will affect mainstream computers in countries around the world, doing nothing to promote national security, but rather pushing the world to alternative technologies. And Nvidia, very much a leading seller of those so-called AI accelerators, the data center operators use here to develop AI models. So again, this restrictions obviously could potentially have a direct impact on their business, and they're being very vocal, to no surprise, about their opposition to this.
Yeah, this is not just Nvidia that's been pushing back against this. You have a lot of organizations, Information Technology and Innovation Foundation out earlier this week. They had their own reaction to this, saying that the rule would impose country-specific caps, along with a license regime on U.S. exports of semiconductors, most notably impact GPU chips that underpin key AI applications, such as the development of large language models. And in all of these reactions that we're seeing, either from companies or from focus groups or from foundations, they're all kind of continuing to note, yeah, this is all happening as the Biden administration draws to a close and has had a series of final acts, closing acts, if you will. But this has largely been regarded as one of the over-designed yet uninformed one, at least from this particular organization here. And no doubt we'll probably hear more from some of the other companies. Nvidia probably stands to lose the most as a result of this, considering the market share that they've built up to this point too.
Markets have been volatile to kick off the year, so how should investors be positioned? Our next guest says that he has top picks for the year, 5 of them, the first being cash, then software company Cisco, the bank ETF KBW, and the S&P mid-cap value ETF IJJ, and lastly, networking company Adtran. Here to discuss, we've got Dan Niles. He is the founder and portfolio manager at Niles Investment Management. Dan, we want to get into these top picks, but it really stuck out to us that a big tech name is missing from this list, and that's Nvidia. Why is Nvidia not in the list this year?
Well, we've been talking about this really since mid last year, and we put out a post on this earlier this week, which is you've seen really strong AI spending on infrastructure over the last 2 years, and obviously Nvidia has been a big beneficiary of that. But we've been talking about this for a bit now. We think there's going to be a pause or digestion phase in AI spending as you get into 2025. And a good example of this is Microsoft. Microsoft on January 3rd put out a blog post that they were going to spend $80 billion in CapEx. And everybody was, oh my God, that's great, that's a big number. If you actually work through the math on that, they spent $20 billion in CapEx in September. They guided for that to go up in December. Microsoft's fiscal year end finishes in June. So that means that in the first half of their fiscal year, they're going to spend over $40 billion, which means in the back half, it's going to be actually under $40 billion. And so your growth rate on CapEx just from Microsoft goes from nearly up 70 to 80% year over year for the last year and a half, will go to basically zero by the time you get to June. And so that's just, and by the way, they're the biggest CapEx spender on AI infrastructure that exists. Obviously, they have that relationship with OpenAI that helps drive that. And that's not something that people are focused on. So that's the big reason Nvidia or any of the Mag 7 are not on this list going into this year. And that's also, by the way, why cash started off the top picks, because I think a pause in AI spending, when you've got so much of the stock market related to AI, and your first question out of the gate was on Nvidia, which shows how much focus there is on it. That's going to be a drag on the market if there's an AI digestion phase coming.
Dan, before we dig into your pick specifically, just zooming out just a bit and just taking a look at, we have the inauguration happening in just over a week from now. Trump policies when it comes to the influence of some of those larger cap tech names that you've just listed, is it a positive for that group, a negative? I guess, how are you evaluating that? I know you're very, very focused on valuation, what we're seeing play out more so in the market dynamics, but how does policy fit into that?
Well, policy fits into that in the sense of, well, what sectors does that favor? So if you approach it from that standpoint, really over the last 5 years, it's really all been about AI or internet infrastructure, starting with COVID, where internet infrastructure was the big investment, then you have AI. Well, what's Trump focused on? He's focused on deregulation, cutting taxes. And that benefits more of the small and the mid-cap type of names, because the biggest companies in the world, they get very low borrowing costs. They don't care. They don't need a tax rate, and they can, to go much lower, they can amortize fixed overhead over big amount of revenues. The smaller and mid-cap names, they don't have that advantage. So for them, this is very helpful.
Markets are currently uncomfortable with high yields, but experts expect them to decrease as inflation pressures ease and the job market softens. Small cap stocks, despite recent underperformance, present potential for 2025 due to their attractive valuations and the pro-business environment. Speculative technologies like quantum computing remain volatile, but a long-term perspective is advised, as past technologies like AI and social media were also initially underestimated. As AI spending slows, safer investments like cash and small-cap stocks might be more appealing in the near future. How do you plan to adjust your investment strategy as bond yields potentially decrease? Are you willing to invest in speculative technologies like quantum computing, or do you prefer more stable options?